Do you want to pay the least amount possible on your taxes if you own a business? This video is for you because we're going to talk through, in my 30 plus years of advising people on taxes, finances, all areas of their money, how we've been able to save our clients $117 million in documented tax savings. The average business owner, according to Forbes, 93% of them overpay their taxes by $11,000 a year. Our numbers are actually $19,551 is the amount that business owners overpay their taxes on each year. So let's dive into some of the most commonly missed deductions, but understand that we're operating from a universe in my office of over 1,500 documented tax savings. So this is just going to scratch the surface of things that we see our clients missing, but we're going to go through them. So if you've watched my entity video, I talk about the most common place that business owners get started, and the one we recommend, unless there's a lot of liability, is with a sole proprietorship. So that just means you're the business is you. You're going to file on a Schedule C. We'll flash that up on the screen, and it just goes right in with your personal returns. So one of the biggest key areas that we see clients miss here is automotive deductions and things like that. So starting off with, if you are driving for business, we want to keep track of those miles, and we want to document where you were going, what it was for. It can be simple as using MileIQ or an app like that, or just a little notepad in your car. That all works great, but that mileage is huge. That ties into another strategy, which is making sure we have an administrative office at home. So even if you're a dentist or a lawyer or a real estate agent and you have a physical office like I do, a place that we come to meet with clients and do business, you can have an administrative office at home. And so how it works for a lot of us in business is I might check email in the morning, respond to a couple things, maybe even have a meeting or two from home while I'm drinking coffee. Then I head into the office. It's about a 20-minute drive. It's beautiful. It's down by the beach. I drink more coffee and I meet with more clients. Then generally I head home. I don't drink coffee at that point. I bang out a few more emails, check the schedule for tomorrow. So all that mileage back and forth becomes deductible, as does the portion of my house that's used exclusively for business. And a lot of people years ago used to claim that was a red flag, and be careful, you'll get in a lot of trouble. It's just not the way we see it working, and those rules changed in 1999. Here's another big one, your purchases. So this is line 13 of a Schedule C. If you buy anything related to the business, we want to keep track of it. That's fairly obvious, right? You need a new printer for the office, you need some software, that would go in a different line. But what about the things that are hybrid? Cell phone, laptop. Well, you can write those off to the extent that you use them for business. What about your travel? You can write that off if there's a business purpose to it. So again, this is more to be idea stimulating of the most common things that are missed. But if you're traveling for business, I made some notes on this, you can, and I'm going to read this exactly because it comes out of the Internal Revenue Code. If you travel to a destination within the United States for business purposes and you spend the majority of your trip days on business, you deduct 100% of your direct route transportation expenses. You may deduct meals and lodging for business days as well. What if it's only a partial business and pleasure trip? You get to write off the proportion of it. What about foreign travel? If you travel outside of the United States for business purposes for fewer than 7 days, you may deduct 100% of your transportation costs of getting to and from your foreign business destination, even if you only work for 1 day, and you can deduct meals and lodgings for the business days as well. So understand there's a lot of things in there like meals and the mileage and the home office deductions and the travel expenses that the average person isn't just capturing. Even the utilities of your home, to the extent that they're used for business, internet, water, electricity, you can write off to your business. Now, once you move beyond that and you begin to get an entity, whether it's the special LLC I talked about in a previous video, an S Corp, a C Corp, now there's additional things that we can do to extract money from that business and not pay tax on it. And let me just give you a couple. One is an Augusta Rule. And I've talked about this before in shorter videos, but let me go into it a little bit more in depth. Basically, the Augusta Rule comes from the golf tournament where people would rent out their home for 4 or 5 days or a week when the tournament was in town, but the rest of the time they lived in that home. They went and lobbied Congress to make sure that they didn't have to pay any tax on that money. And Congress made a special rule, I think it's section 280 AG or GA or something like that, but it's permanent in the code, that says that you can rent your main residence to anyone for up to 14 days. So you can Airbnb it for 14 days or VRBO it. You pay 0 tax on the rent that you receive. Day 15, you got to pay tax on the whole thing. But now, remember, as a sole proprietor, you're the business is you. There is no separation. You're it. So you can't rent to yourself. But now that you get a corporation and we've separated those out, you can rent your house to your corporation for board meetings, business meetings, client meetings for up to 14 days at a fair market rate. And oftentimes that fair market rate is higher than you'd imagine, particularly when you source it and look at what room rentals by the hour look like around you. You can even provide food, coffee, happy hour, meals, things like that, that all are deductible to the business, but not taxable to you. Another thing that you can do is set up a family management office. What's that? That's where most of us got started if we had small kids, by paying our kids to help us with the business. By the way, you can do this with the Schedule C also, but you can do it with an S corporation or a special LLC as well. And you can generally pay them, as I record this in 2025, up to $15,000 a year, provided, again, they have to be doing something that would justify that. You can pay them more, but at $15,000 under current rules, that's the amount of the standard deduction. Meaning they can receive $15,000 that's tax deductible to your business, that they owe no federal tax on. State may vary sometimes, but most don't. And so we took money from your company, put it over to your kids. Maybe we invest it for their college, talk about what to do with that later. But the idea is that one chess move, for a lot of my clients, will save $5,000 or $6,000 or $7,000 a year in taxes per kid. So those are some of your basics. We can get into employee benefit plans, accountable plans, all the workhorse strategies that you should be looking at and your accountants should be bringing to you. And if they're not, which likely they aren't, because again, that's how we got to 93% of the business owners, according to Forbes, overpaying their taxes by that 11,000 number that Forbes gave you. We say it's more like 19,551. Not that we're counting, but that's how you get there, because most accountants are scorekeeping for the previous year rather than coaching you for the current year and beyond on what to do to pay the least amount of taxes. So I could go on all day, but we wanted to keep this to a reasonable amount of time. But I want to leave you with one final thought. I talk a lot, and my team talks a lot about opportunity cost. And that simply is when you lose $1 because you overpaid it to taxes or for any other thing, it's never just the dollar that you lost. It's everything that the dollar would have earned for the rest of your life had you not lost it. So if you overpay your taxes, tip the government. That's literally what you're doing, putting a gratuity for them. If you did that for $11,000 a year, the lower Forbes rate, not my higher number, for 30 years, you would have lost $1 million. Because if we took that $11,000 and invested it at 7%, a boring run-of-the-mill ETF that you can get anywhere, Vanguard, Fidelity, Schwab, it doesn't even matter. You just lost $1,039,000. How many times can you afford to do that? And for how long are you going to keep doing that before you take this seriously? So, hope that gets you motivated into action to start being proactive. Of course, if you want to chat with us, we'd love the opportunity to chat with you about your situation, to see if your number's higher, lower, and to talk about other areas you may be losing money unknowingly and unnecessarily. It's why we get up in the morning. It's what everybody on my team nerds out about. We love this stuff. We love saving our clients money. We love putting them in a better position than they started on. But it starts with you hitting that subscribe button and making a time to come and chat with us if you think we might have some of value. So I hope you learned a lot. Hit that subscribe button. We'll see you in future videos.